So here's an example of one we just did this past week, and this was on Caterpillar. So the basics for the trade was that CAT had been really a big, huge move to the upside and got very extended, overbought to the upside, and looked like, based on our indicators that we use, it was starting to stall out, what I call buying exhaustion. So it was starting to stall out at this big, huge move to the upside that it had. And with that happening, potential is for it to start kind of pulling back. So buying exhaustion leads to what we call maybe a cycle reversal from the upside or downside. So from this situation, bullish to bearish, or you can do this from bearish to bullish, kind of reversals. So this trade we set up on the 15th, which was, I guess that was Tuesday. And at that time, CAT was trading at 237.45. So we went out, and you can see here it says new CAT short. So it says it was trading at 237.45. So it was a counter trend trade at that point in time based on what we call overextended. It was into our 3 average true range of our indicator, very overbought. So we had a target, first target 232, then down at 230. So this one was going out and buying the calendar. Okay, so it was buying the 9 December 230 put and selling the 18 November 230 put. So you can see the strikes are the same. So the 230 strike, but you're selling the November 22 230 and buying further out the 9 December 230. So in summary, you're going to be long the 9 December 230 put and short the 18 November 230. So this one ended up going out, did really well. So on the 17th, that was Thursday, it was starting to trade lower. And so with this one, we took some profit, or took profit if you wanted, took it all, and then adjusted for a bigger move down. So with this one, we did an adjustment where we took it and we closed out the short strike here that was at the 18 November 230, and we replaced that by selling the 18 November 225 put. So now we have a long the 230 put here and short below it the 225. So this is what we adjusted it to in this situation, a put calendar diagonal. But let's go through it and show you how the revenue came in and how this generated some really nice income. So again, this was an alert trade that was just done this past week. So here was the trade set up. It was coming in right here. We had the reversal crossover right here. This was a very overbought, over 90 percentile overbought. We had our indicator, the white line crossing the 14-period moving average of that indicator. That's what gives the signal. And being very extended, this blue line is 3 average true range. So we sold it the next day right there. And we weren't looking for much of a move. We were just looking for a move down at 230. So you can see it was trading at 237, and we were looking for a move down at 231, 230. And it moved down here it made a low of 228 and kind of went out right around that 230 on Friday. So it was actually really perfect kind of scenario for this trade. So here's what it looked like going out. So this was on the 17th. We had a profit take and adjustment on the 17th. So set it up, was traded at 237.45. Then on the 17th, it had traded down to 229.46. So at that point in time, we closed out the trade or took profit on part of it. At that point in time, it was up $120 per spread right here. So your cost of the trade, your max risk was your debit pay 345. So that's a 35% return in 2 days. Now, the thing with this trade, if we want to stay in it longer, since we're long the December 9 series further out in time, we could have stayed with this trade by just closing out the short strike and going to the next series. We ended up just closing out the whole trade on Friday because this trade was set up just for a move, just for a small move down to around 230. So you can see here on Thursday, up $120. And then if you held the trade into Friday, which a number of the members did, it went out up over $200 yesterday. So again, this is all from theta decay and volatility decay or a crush. So here you can see yesterday it was trading here at 231.43 going out in the afternoon. So it's trading right there. So this went from a spread of 345, now is up to 547, so up $202 per spread on that risk of 345. Now it's a 56% return. So this was just playing that range for just a small downside move. And then if we wanted, we could have stayed with the trade by that adjustment to the calendar diagonal. So a great strategy when you're just looking for a small little sliver moves down or up. This is a really great way to do it, and you're getting paid to wait if you're trying to wait it out for that break. But you can set these up for very, very small moves on low at risk type of capital that you put up. So it's really been a great favorite of Power Cycle Trading as far as the alert service